4 questions 50% CFA Level 1 candidates failed to grasp, including one crucial one at the end. Accounting choices and estimates. Question 4. To increase reported earnings for the current period, a company's management would most likely A. Increase the estimated salvage value of its delivery vehicles. B. Write down the value of its inventory for obsolescence. C. Shorten the amortization period for a purchased patent. Correct answer: A. Think of salvage value as how much an asset is expected to be worth when it's no longer useful. To figure out depreciation expense, you subtract the salvage value from the cost in, then divide by the useful life. If you can boost the salvage value, you're essentially reducing the amount you need to depreciate, which is the cost minus the salvage value. This means you'll pay less in depreciation each year. And guess what? Less depreciation means you'll see a higher net income in the current period. Management gets to decide on accounting estimates, like what a building will be worth when it's no longer useful or how long it will last. Sometimes, managers try to make their profits look better by saying a building will be worth more than it really is when it's old. That's a bit of a risky way to handle the books. Aggressive accounting. Overstate revenues by recognizing them too early. Understate expenses by inflating the salvage value or extending the useful life of assets. Delay writing down assets or setting aside reserves. Conservative accounting. Accelerate the recognition of expenses by using shorter amortization periods. Make timely write-downs when necessary, such as when inventory becomes obsolete. Be incorrect. Write-down of inventory loss reduces gross profit in net income. C. Incorrect. Amortization expense allocates intangible asset costs over their useful life, impacting net income. Thumbs up and subscribe this channel. Question 3. A company wants to minimize the impact of changing its salvage value estimate on current period earnings. Which depreciation method makes this change least effective for managing earnings during the asset's early life? Straight line. B. Units of production. C. Double declining balance. Correct answer: C. The double declining balance (DTB) method is a way to figure out how much an asset loses in value over time. It uses a faster rate than the straight line method, which is double the rate. In the beginning, the salvage value isn't taken into account when you're figuring out how much to depreciate the asset. Instead, you keep depreciating it until the asset's value drops to the salvage value. So if you change the salvage value estimate, it won't affect how much you depreciate the asset right away, especially when it's still young. That's why it's not the best way to control earnings by changing the salvage value. A. Incorrect. Depreciation in straight line method is calculated as cost minus salvage value divided by useful life. B. Incorrect. Depreciation per unit changes with salvage value, affecting current period expenses based on production. In the DDB method, changes to salvage value don't matter much in the early years because depreciation is calculated using the book value, not the salvage value. However, in the straight line and units of production methods, changes to salvage value can quickly impact the depreciation expense, giving management a way to tweak their earnings. Question 2. A company's management, concerned about meeting an earnings target, decides to delay the planned maintenance and overhaul of its manufacturing equipment until the following fiscal year. This decision to reduce current period expenses is best described as earnings management through A. Non-compliant accounting practice. B. A real operating action. C. A change in an accounting estimate. Correct answer: B. Earnings management. This involves using your judgment in financial reporting and how you set up transactions to tweak financial reports, potentially to trick stakeholders or sway contract results. You can do this by making accounting decisions, like changing how you depreciate things or estimate costs, or by actually changing how you run your business, like putting off maintenance or cutting back on R&D. Real operating action. This refers to making actual changes to how a business runs to impact its earnings. For instance, You might choose to hold off on buying new equipment, cut back on advertising, or put off fixing things that need attention, like what we are doing here. These moves actually affect the economy and aren't just changes on a spreadsheet. Non-compliant accounting practice, option A. This could mean breaking the rules of generally accepted accounting principles, GAAP, or International Financial Reporting Standards, IFRS. Putting off maintenance isn't really an accounting rule. It's more about how we run things. Even though the costs will still come up, they'll happen later on. Change in an accounting estimate, C. This is when we tweak the assumptions we use in accounting, like how long an asset will last or how much we should set aside for bad debts. Just to be clear, putting off maintenance isn't really an estimate. It's a real decision we make about how we run the business. So the company is shifting when they'll spend money on maintenance and overhauls, which helps them save money now and look better financially. This is a good example of how companies can boost their earnings by actually changing how they do things, instead of just making numbers look better on paper. One crucial questions. Question 1. A company reports under US GAAP in a period of rising prices. Which inventory accounting choice would most likely increase reported stockholders' equity compared to the alternative? A. Adopting FIFO rather than LIFO. B. Switching to LIFO rather than FIFO. C. Using weighted average rather than specific identification. Correct answer, A. When prices are going up, inflation, how you account for your inventory can really make a difference. If you have more COGS, cost of goods sold, that means less profit and less money in your pocket. But if you have more ending inventory, that adds to your assets, which can boost your stockholders' equity. Think of it as your company's net worth. Since net income goes into retained earnings, which is part of your equity, using methods that boost net income can also help you build up your equity. FIFO, first in, first out, is like saying that the first items you brought in are the first ones you sell. When prices are rising, this means you're selling the older, cheaper stuff first, which helps keep your cost of goods sold down. That means you're making more money, which boosts your profits and net income, leading to more money for the company to keep. So, your ending inventory shows the newer, pricier items, which makes your total assets and equity grow. Be incorrect. LIFO inventory method results in higher COGS, lower profits, and decreased equity during inflation. C. Incorrect. Weighted average cost method averages inventory costs, resulting in COGS and net income between FIFO and LIFO. Specific identification. This method keeps track of the exact cost of each item you sell, especially for things like luxury items or special finds. The impact on your equity depends on which specific items you sell, so there's no one-size-fits-all answer. It's hard to say exactly how specific identification will affect your equity without more information, but FIFO is usually better for maximizing equity when prices are going up. Even though FIFO gives you a higher net income and equity than weighted average when prices are rising, it still works out better.